Hi, in this session we shall understand how a stripped treasury security is created and understand the difference between a coupon strip and a principal strip. The prerequisite for this session is that you understand the structure of a plain vanilla bond. So let's get started. The investment bankers noticed that the Treasury does not issue zero coupon treasury bonds or treasury notes. And they also noticed that the investors have different demands regarding maturities. So they came up with an innovative idea of stripping up the normal treasury bond and note and creating new securities with a shorter maturity. That is, what they did was they took the treasury bond or a treasury note, right? These have lots of payments, right? They have the coupon payments every year, and in the last year they would have a principal payment, right? What these investment bankers and dealers did was they converted each and every cash flow from this treasury bond into a separate security. That is, they created a new security out of this, right, and called it strips, right? And this strip was sold at a discount to the par value, and then at the end the investor would get the par value or the principal amount, so he would gain an implicit interest, right? So like this, for every cash flow they created a security, and if the cash flow that they used for creating the security was the coupon payment, then the security was called a coupon strip, right? On the other hand, if the cash flow used for creating the security was the principal payment, then the security was called a principal strip. This was also issued at a discount to par, and then at the maturity date the investor would get the entire principal. So as a result of this, let's say there was a treasury bond with a 10-year maturity, right? So how many cash flows would this treasury bond have? It's for 10 years, and treasury bonds are semi-annual payments, so it would have 20 coupon payments and it would have one principal payment, correct? So with the help of this separate trading of registered interest and principal securities, which was introduced by the Treasury in 1985, this treasury bond would now be converted into 20 coupon strips and one principal strip. So you're creating 21 securities out of this single security. And these securities should have a shorter maturity, right? So since they have a shorter maturity, investors who are unable to invest in this long-term treasury bonds would now be interested in investing in these coupon strips or the principal strips. So these coupon strips are denoted by using CI, right? And the accrued interest in a coupon strip is taxed, even though the interest is not paid until maturity, because here the gain is the implicit interest, right? Because of this taxation, they'll have negative cash flows until maturity. And the principal strip is denoted by using either BP or NP, right? If it is used from treasury, if it's created using a treasury bond, you would use the notation BP. If it's created using a treasury note, you would use the notation NP, right? And if for some foreign players, the interest gained on principal strips are taxed as capital gains tax. So now let's try and answer this simple question. Which of the following is least likely to be true regarding the Treasury strips program? It allows reconstitution of treasury bonds by clubbing individual cash flows together to create treasury securities. This is correct. Allows dealers to divide treasury bonds into the coupon payments to create zero coupon bonds. This is also right. This was the main aim of this treasury strips program, because there was no zero coupon treasury bonds available. So these dealers came up with the concept of splitting these treasury bonds into multiple zero coupon bonds. So this is also correct. The separation and reconstitution of Treasury securities creates an arbitrage in the market. This did not happen as a result of Treasury strips program. So this statement is false. Carl, a fixed income analyst, is discussing investment strategies with Karen. He says that a $100 million 8% 10-year semi-annual Treasury note issued by the US government can be stripped into 20 Treasury strips. And the 20th Treasury strip is the final coupon and the principal strip and has a maturity value of $104 million. Karen disagrees with both the points which Carl made. She is most likely correct regarding what? So first let's see how many strips would this bond have. It's an 8% 10-year bond with a face value of $100 million. Treasury notes have semi-annual payments. So as a result, there would be 20 coupon payments and there would be one principal payment. So as a result, a total of 21 strips can be created from this Treasury note. And at maturity, which is the principal repayment, would be worth $100 million. So the 21st strip would be worth $100 million, which is the principal repayment which is happening. So here Carl said that the maturity would be $104 million, right? And the number of Treasury strips is 20. So he is incorrect regarding both the statements which he made. So Karen is correct regarding both the points. Her stand is right in both the cases. So if you see choice B, it says that Karen is most likely correct regarding both the number of Treasury strips and the maturity value. So this is the right answer. That brings us to the end of this session. Thank you.